The S&P 500 is at record levels. Bitcoin's at record levels. The markets have been doing extremely well since Trump's election win. The S&P 500 closed above 6,000 earlier this week, the first time ever, as stocks continue to rally. But I'm going to look at whether stocks are dangerously overpriced and if there could be a market crash coming, or if it's still a good time to invest. So a good ratio to look at is the Shiller PE ratio. So this is an inflation adjusted earnings number from the previous 10 years. So it sort of normalizes just looking at the PE multiple in its isolation. This looks at 10 years. So if we look at where the Shiller PE ratio is right now, it's at a multiple of 38. And it's concerning when you look at where it's been in the past. So if we go back to 2021, it was at 38.58 at a high of October 2021. And what happened afterwards in 2022 was a massive crash in the markets. The S&P was down almost 20%, Nvidia down 50%, Palantir down 64%, Meta Platforms also down 64%. So it was a big crash in 2022. So that's one thing to keep in mind, is as quickly as these stocks have skyrocketed, they could also be crashing down, especially as their valuations have gotten really extreme. And then if we go back to the 2000s, that was, of course, the dot-com crash. So back then, the Shiller PE ratio was even higher, but then you can see a big drop afterwards. Then we go back to 1929, the massive market crash that was almost 100 years ago. Again, Shiller PE ratio of over 31. We're well above that now. So, long story short, basically, the Shiller PE ratio has never been this high and been able to stay this high for long. I mean, dot-com crash was the exception, but it eventually went down for a big crash. So I would say based on this, the data does seem to suggest that the markets could be overdue for a big correction. Another way we can gauge valuations is by looking at the Technology Select Sector SPDR fund. So this is the tech sector of the S&P 500. So we've got stocks like Apple, Nvidia, Microsoft. These are the big stocks making up this fund. And if you look at its PE ratio at more than 41, so that's fairly high at a time when the growth rates for some of these stocks isn't all that high. Obviously, Nvidia is doing really well. Microsoft's and Palantir, let's say, are growing at around 20%, but other tech stocks are starting to slow down, and so it's not. It's a fairly high multiple to be paying if the growth rates aren't exceedingly high. And obviously, a big reason that tech stocks are doing well right now is because of the hype in AI. But there are warning signs out there. For example, Microsoft's Copilot, although it's used heavily in corporate America, a lot of companies aren't 100% sold on it. In a recent survey from CNBC, there were a lot of companies that hadn't implemented it fully, and that they were still on the fence of whether to use it or not. So it says 50% of respondents said their organizations have made the decision to deploy it to all employees, but 17% say did not fully adopt Copilot, and it says another third are still in the testing phase. So even though Microsoft's been pumping out Copilot as a really big AI capability, a lot of companies aren't sold on it. And when you consider that they're paying $30 per month per user, that cost can quickly become really significant. And I've used Copilot for Microsoft Office, and while it's nice to have, it's not really. It's really difficult to justify that kind of expense. It's not some game-changing technology that's just going to do your work for you by any stretch. It's still in its early phases, and I could see how it could be difficult for a company to justify paying that kind of a price, especially when it's on a per-user basis. Another thing to consider is a recent report from Gartner, a research company that says up to 30% of generative AI projects will be abandoned by the end of next year. So this is as companies who have invested in AI technologies have a hard time justifying their payoff. And so the risk is that these companies could start to scale back on these AI projects, on their AI spend. And so the massive growth that some of these tech stocks are generating right now could start to slow down significantly. And especially when they're going up against strong comparable numbers from this current year, 2025 earnings or 2026 earnings could look really bad in comparison. So the risk is that companies may not be seeing a whole lot of payoff from these AI investments. And so, especially next year, if there's a slowdown in the economy, if there's a recession and companies need to cut back, then we could see a whole lot less spending in AI. And as that hype sort of dwindles down, there could be a big sell-off in the markets. And in a lot of ways, this reminds me of the hype around the metaverse a few years ago when everybody thought that was going to be the next big thing. And, whether it might be or will be or not, what happened afterwards was companies cut back their spending as well because of inflation and rising costs. They needed to cut back. And then, generative AI has sort of created a new opportunity and sort of given them a reason to invest again back into tech. But if companies start to scale back next year, then again, there could be significant layoffs and job cuts, and that could be disastrous for the markets. So I do think there is a high probability of a crash happening in the next 1 to 2 years, depending on how all this plays out, just because many stocks are highly overpriced right now, trading at more than 50, 100 times earnings, depending on which stock you're looking at. And so valuations are extremely high. So there are still good buys in there, stocks that probably aren't involved in tech that might be better value buys, but it's an important time, I'd say, to definitely look at valuations, because the dangerous part is assuming that these stocks are just going to continue going up and up and up, because realistically that's not happened. That's not going to happen. That hasn't happened historically. So I do think it's a time to really take a long look at some of the stocks that you have and whether their valuations have gotten out of control and whether it might be a good time to consider selling, because it can't continue going on this trend for a whole lot longer before there could be a pretty significant correction.